Welcome back, awesome people. In today's episode, I will be going over what beginning investors should do and should not do to be successful in the stock market. So if you are a pro investor, this video is not for you. But there are some cool strategies that you may want to stick around for. So get bullish on that subscribe button for the YouTube algorithm and smash all the likes, bells, and whistles to help the channel grow. And to get all my updates on these fantastic investments, and comment below with what you think, because I do reply to every comment. When a person begins their investing journey and type in the simple words, how to start investing or investing for beginners, they are bombarded with countless websites, book recommendations, people trying to sell them information packages, and others will go as far as to ask you if they can invest for you with your money. Please never do that. So with all this resource overload, what is a beginning investor to do? Well, first thing you should do is check out my learning series that I created for beginning investors, which goes through how to start investing, what broker is best for you to use, and investing strategies that will help you start making profits. So go back and watch those, and to make it even easier to watch, I have compiled them in a playlist for you awesome viewers. Okay, so now that you are ready to invest, you should consider the following tips and strategies to maximize your potential in the market. I will go over what to focus on and what not to focus on, and give you a summary at the end. So here is what not to focus on. Repeat, not to focus on. First thing, day trading. As a beginning investor, yes, day trading can give you the opportunity to make you great daily gains, and it is quick, but the bottom line is that day trading carries a high risk. There is never a guarantee that you will make money. In fact, according to the US Securities Exchange Commission, or the SEC, day traders typically suffer severe financial losses in their first few months of trading. So simply put, don't day trade as a beginning investor. The second don't, penny stocks. Now, penny stocks are great ways to diversify your portfolio and to take a chance on a company based on your belief of their products and services. But it is a high risk stock that trades for a low price outside of major market exchanges. It has a lack of history and information, and also you should learn how to read a basic chart where you can forecast pump and dump penny stocks as well, so you know if a penny stock is even worth the investment. And make sure you follow me on my Twitter at Jacob Rant, where I will be posting the penny stocks that I buy and sell. And subscribe, because I will also be posting a video in the coming days about how to read a basic stock chart. So follow and subscribe. The third thing that every beginning investor should try to stay away from is cryptocurrency. I know cryptocurrency is a great asset to add to your portfolio, and I do believe that whether it is Bitcoin or some other digital currency, that it is the direction that society is going. Digital currency. So I am not against beginning investors jumping into crypto. I am against beginning investors jumping into crypto without any knowledge or experience with the stock market, because crypto is still a high volatile asset. So getting your emotions under control on red days is key when it comes to crypto because of its high fluctuations. So do your own due diligence. And the dreaded Forex. Simply put, Forex is you are buying and selling foreign currencies. So beginning investors, stay away. I highly warn any investor, whether you're beginning or not, to be very careful with Forex because it is highly volatile unless you understand global business and economics, as it will be difficult to forecast your next move. Plus, there are many agencies and companies that are set up like a pyramid scheme that will convince you to join their Forex workshops and hook you in. So be careful of Forex scammers. My opinion, just stay away from it. chasing high yields. Well, beginning investors, once they learn about dividends and yields, they start chasing companies with the highest dividend yields. But a high dividend yield, however, may not always be a good sign, since the company is returning so much of its profits to its investors rather than growing the company. Also, companies with a high yield, like the ones that pay above 7-8%, have a higher chance of reducing or cutting their dividends if they need it for cash flow, compared to companies who may have a lower yield, such as 2 to 3%. So don't chase high yields, chase the quality of the overall company, as those companies have higher chances of raising their dividends. And who doesn't like a pay raise? FOMO. FOMO. Well, FOMO is the fear of missing out, the fear of not getting in the momentous runs of a stock or a sector. And you hear people making money, and then as soon as you jump in, the stock goes down. What happened? Well, those who create the run-up of the stock know what is going on and have a timeline and an exit strategy. For example, when I saw the GameStop frenzy a couple months ago going on, I did jump in, and 2 days later, I jumped out. My plan before jumping in was that it will be a 2 to 3 day hold. I was grateful to have made 130%, even though it did run up more after. Because with FOMO stocks, you really have no idea when it will go south. As I said in my previous videos, these FOMO stocks are usually pumped up by other users or a good collective community, and they will always let you know when to get in, but they will never let you know when to get out. They will continue saying, hold the line, hold the line, don't be a paper hands, don't be a paper hands. And you should check out my previous video on diamond hands, where I go into detail about what this whole phenomenon is all about. So check that video out called Diamond Hands. So because with FOMO stocks, you have no idea when it will go south, by having a plan and exit strategy, you will have a better chance at benefiting from a FOMO opportunity if you did decide to jump in. And for those that did jump in the GameStop frenzy and AMC frenzy while it was near their highs and still holding the bag, well, may those bags teach you a lesson of creating a exit strategy. So for a beginning investor, do not think you need to jump in on every hype, as there will be hundreds and thousands of FOMO opportunities in the future. So learn how to read charts and get better at forecasting. So if you are thinking of starting to invest and don't know where to start, you can follow me along my Wealth Simple Trade Challenge journey, where I will be turning $100 into $1,000. And follow me on my Twitter account at Jacob Rant, where you will see my daily buys and sells and my portfolio. And who doesn't love free money? So if you want free money to trade with and $0 commission fees that won't eat into your profits, sign up with my Wealth Simple link down in the description box below. So now that I have highlighted what not to focus on and to not do as a beginning investor, now it is time for the factors that you should focus on as a beginning investor, as this will maximize your returns and it will keep you building your success and wealth. First thing to focus on starting off as an investor in the stock market, or any investment for that matter, the fundamentals. Fundamental analysis is good for any investment: real estate, stocks, a business, startup, or even just loaning someone $100. Like, fundamentally, does this person that I am lending money to have a history of paying things back or not? That is simply the fundamentals. The company's track history, their chart patterns, their resiliency through their ups and downs, their ratios, and even the management team, and the ability to identify and predict economic, demographic, technological, or consumer trends of a company can benefit any investor. So never buy a stock without understanding some of the basic fundamentals of a company, like how much debt they are in, how much money is coming in, what were their earnings, what are their future forecasts, and so on and so on. And I will be posting a video in the coming days about identifying the fundamentals of a company. So subscribe and click the bell to get notified of when I post that video. Another factor that many beginning investors tend to stop doing and neglect is continuously learning. always learning. Beginning investors tend to learn the basics, start trading, and then boom, learning becomes a thing on the side, and they are all in. No, don't do that. Even Warren Buffett, some of the biggest investors, still to this day read and learn. Even if they reread the same book, the refresher highly benefits their investing choices. Although many people recommend the same books like Rich Dad Poor Dad and the whole book collection, there are still plenty of other ways you can learn. You can listen to podcasts, YouTube videos, just like how you're doing now. So thank you and subscribe. And even just having a conversation with others is learning. So don't think that you can just stop learning just because you have a basic understanding of trading and investing. Learning is forever. And one of the most major factors, a budget. Now, when creating your investing plan as an investor, you have to have a budget. You cannot just throw money into the market without a game plan. I say this in all my videos. Always have a plan. Always have a plan. If you do not have a plan, you will most definitely have a higher chance at making sporadic decisions. So what you need to do is create a plan, and within that plan, create a budget. I will also be posting a video in the coming days about how to create an investment plan, so subscribe to get notified. So now, the budget. Budget the money you get from employment and any other incomes, and depending on your comfort level, decide a percentage or amount that you will invest regardless of your situation. Many financial advisors suggest some type of 50-30-20 rule, where 50% is directed towards your needs, 30% is directed to your wants, and 20% directed to your savings and investments. Well, since I'm not a financial advisor, I am just a clown on YouTube, I personally do not recommend that rule, because 30% for wants? Like, what are you buying? That is way, way too high for me. I suggest a 50-10-30-10 rule, especially in the current climate that we are living in, and that there are not many wants that can be explored. Not much traveling or restaurants and so on. So my suggestion is 50% goes to your needs like housing, bills, food, etc. 10% goes to your wants. 30% goes to investing in the stock market, and 10% goes into a high interest savings account. This rule of mine puts investing and creating wealth at the focus, instead of keeping your spending balanced in all categories. And in a few years, when many of our luxuries of life come back to normal, then you can definitely adjust the rule and increase your wants, as by that point, by following my rule, you would have created a nice cushion in your investments and in your savings. And if you decided to focus on buying dividend paying stocks, by the time our luxuries come back, you can use your dividends to pay for your wants. So using money as a tool to make you more money allows you to use free money to pay for your wants. And this is the only way to let your money continue growing while you are enjoying your wants. And since we are on the topic of the best wealth creator, dividends, and if you want more tips that focus on dividends, check out my previous video called Buying Dividends after this video. So now, when buying dividend stocks, you have the option of reinvesting the dividend payments you received to buy more stocks, or you can take it out as cash and do as you please. But the reason the dividend is considered to be one of the greatest wealth creators is for the compounding ability. By taking the dividends, which is essentially free money, and buying more dividend paying stocks, which will essentially be free stocks since you bought it with free money, and as a result you will be growing those dividends and they will be compounding to the point where you can simply live off of your dividends. It's simply supercharging your long-term returns because of the power of compounding. And by holding reliable and strong companies like Coca-Cola, Johnson & Johnson, for example, you can pass your portfolio on to your next generation and continue the process of reinvesting and living off of dividends. So I always suggest that beginning investors to buy dividend paying stocks before they invest in speculative or non-paying dividend stocks, so they can have a comfortable passive cushion to start the compounding effects for long-term wealth. And my awesome people, that is one way of how generational wealth is created and passed down. So beginning investors, to summarize, stay away from day trading and Forex. Let me repeat that. Day trading, Forex, no. Second, have a good knowledge and understanding of how to read a stock chart and the fundamentals of a company before investing in any stocks, especially if you plan to invest in penny stocks and cryptocurrency. Third, dividends are the greatest wealth creator because of its compounding power. However, do not only chase companies that have a high dividend yield. Chase companies with a good yield and is an overall strong and reliable company. And finally, do not stop learning. Those who continuously learn and willing to absorb information will do far better than someone who invests blindly or based off of just FOMO. Only those who research and learn will be able to see if the FOMO or even penny stock or spec stock is even worth it. So always learn and make calculated decisions and not emotional ones, because emotions can run wild when you see your portfolio in the red. So again, if you are thinking of starting to invest and don't know where to start, you can follow me along my Wealth Simple Trade Challenge journey, where I will be turning $100 into $1,000. And follow me on my Twitter account at Jacob Rant, where you will see my daily buys and sells and my portfolio. And who doesn't love free money? So if you want free money to trade with and $0 commission fees that won't eat into your profits, sign up with my Wealth Simple link down in the description box below for $25 of free real money to trade with. So again, I am not a financial advisor, so make sure you do your own research and consult your own financial professional. Thanks. There is so much wealth out there for all of us to get a piece of. So by allowing our hard-earned money make us more money is the key to wealth and the key to financial success. So subscribe, like, and share to help out this channel grow, and so you will get notified of when I go on YouTube Live or of my recent posts, as I will be posting my penny stocks, REITs, dividend, and speculative stocks from my portfolio and investments that I am currently buying and selling. And again, follow me on my Twitter at Jacob Rant so you can see my daily plays. Also check out my recent video of my journey of swing trading $100 to $1,000 through my Wealth Simple Trade app. So subscribe. I want everyone to have the opportunity to get out of this work-life trap by buying back their freedom through investing. So let's all ride 2021 together on a journey of health, love, success. So until the next video, stay ranting.